Business leaders are telling us is their hiring expectations for the coming year mimic a lot of what we saw last year. So it's not going to be breakneck speed, but we're going to continue to see replacement hiring. We're going to see some expansionary hiring, and we're going to see hiring growth a little faster than 1% in the coming year. So that's all good. And we expect wages to accelerate faster. So we expect wages in the coming year to be growing faster than they did in the last year. This is the first drop in their confidence, their expected confidence for the coming year since the Great Recession. So we've been consistently going up, and we had reached late 1990, early 2000 type confidence numbers. And this is the first year that we started to see a drop. And there was a much larger drop by private industry than there was by government. The big takeaways from last year was it's just as strong as we thought it was going to be. There was good sales, there were good profits. We saw wages really start to accelerate as we went through the second half of the year. And we started to see prices rise just as we expected. So all of that was part of last year. And a lot of that story from last year was the tax cuts. The bad news is that part of the story goes away for next year because the benefits of that all were really primarily last year. And the story for this coming year is going to be trade. The best thing is the expectation for the year on hiring and sales is still positive, and the firms are still talking about the fact that they're going to be profitable this year. So do we expect things to slow down compared to last year? Yes. Do we expect that we're going to drive off a cliff? No. We have a much smaller group of fast-running companies right now that they're much more cautious about their expectation, and that expectation is more moderate than it was last year. One of the more pessimistic groups was out of automotive. So when we look at that group and isolate that group, we were looking at the growth really being steady to trending downward a little bit. So we're looking for a slowdown for those individuals supporting the automotive sector. Furniture came off their peak about mid-year, and it's been slowing down a little bit. What we're seeing right now is that uncertainty in investment by firms is leading them to be more cautious in investing in goods for their business. That negatively affects the office furniture. So there we're also expecting flat to slightly downward trend. As we talked last year, we said as we reached the end of 19, we would have an increase in the probability for a recession, and we are still in that condition right now. If we look at a lot of the major surveys out there, economists are really talking about 2020, and CFOs are really talking about 2019. Our data is really still looking at the very end of 19, the very beginning of 2020 as being the most probable start. So I think the discussion that's going to be had as we get into this first quarter of 2019 will be a question of, is it going to be a hard landing or is it going to be a soft landing? The data is still a little thin, but it looks like in West Michigan there's a good chance that it will be a soft landing. Well, certainly trade is creating uncertainty for businesses. So even though the reductions that we're seeing or the changes in trade that we're seeing as a result of the trade actions happening politically have had a relatively small direct effect on our growth, the fact that businesses are a little unsure as to what to do and they're pulling back their investment, that has a much larger drag on our growth, and that will grow as we go into next year.